In this module, we are going to discuss everything you need to know about auditing in 10 minutes or less. And maybe that's an exaggeration, but I think as you're sitting down to plan an audit, these are the things you need to think about as you start to do your planning. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now the key message of the risk model, and I've got it in red, if risk and material misstatement is low, which it often or might always be in a smaller audit, and we can't, it could be wrong, but we can't think of a particular reason. Risk and material misstatement is then low, not a lot of work is required, brief control test perhaps, some broad analytical procedures. It's all we need to do. We need to do a low amount of work. That's the key message. Now, risk and material misstatement could be negligible, prepaid expenses that is not material. Probably compare it to last year only. Prepaid expenses are 10,000, materiality is 100,000. As an auditor, we go about the same as last year. We're good. Now, the controller attitude is get the invoice, find the number of days, do the math. And that's what a controller should do, but an auditor goes, about the same as last year, that's the end of my audit work, moving on. Now, risk and material misstatement can also be moderate, high, or significant. Definition of significance not that good. It used to be a significant risk and material misstatement was significant. Now it's at the high end of the spectrum. We're probably talking something where no amount of audit work is conclusive. And if we do rate it as significant, we have a key audit matter and have to put something in the audit report. High risk and material misstatement is, well, we're concerned. We've got a specific risk that may mean that it's wrong. But if we do that higher amount of work, we can stop if we don't find anything. And moderate is somewhere between low and high. So identifying risk and material misstatement, very important. It's a key part of planning, is why we do risk assessment procedures. Partner involvement is required and documentation is required. And I think we do those two things even if they weren't required by standards, because they're so important to doing the audit correctly. We have to document why. Specifically, why do we think risk of material misstatement is high? Now, I'm just worried it could be wrong. That's not enough. You have to have a specific reason. You have to document the specific assertion, and you have a specific reason and have a specific assertion so the testing done targets and or matches the issue. And that's also required. And again, you do that even if it wasn't required. So you have to document and say why. You have to have a reason. Now you can phrase that as, what journal entry can I make? What journal entry do I think needs to be made, might need to be made, and how will my testing help me come up with that journal entry? If you can't do that, if you can't say, well, I think this is the journal entry I might find, or if you do find the journal entry, you're just reclassifying expenses in a way that doesn't change the financial statements in any way, go back to risk and material misstatement, go back to the assertion. It's got to be something that materially affects the financial statements. And if it's not, we're wasting our time. Now, fraud. We don't care about fraud. The auditor doesn't care about fraud. An employee took pencils from the supply room. Standards define that as theft. Theft is defined as fraud. We don't care. The financial statements are not materially misstated. An employee is paid too much. The employer is careless. They paid somebody a couple of bucks too much. We don't care. That's how much they were paid. That is the expense. Now, the controller cares, but the auditor does not care and doesn't need to do audit procedures for that. And anyway, even if we could get the money back, it's a contingent asset, so we don't record it. Now, what the auditor cares about is fraudulent financial reporting. Are the financial statements materially misstated because of fraud? Now, the other thing to remember is 99 times out of 100, if there is fraudulent financial reporting and we stumble across it and say to the client, hey, this is wrong, and they go, oh, gee, we're surprised. Now, they're not really surprised. They did it on purpose. They got caught. But they're never going to say, yeah, we did that fraudulently. So we will probably find an error, never realize that it's fraudulent financial reporting. But as long as we correct it, that's fine. So are assets too high? Expenses are too low because we reclassified something from repairs and maintenance to fixed assets fraudulently. Did we record a bunch of receivables on a bunch of phony revenue? Assets are too high, revenue's too high. Our liabilities too low. We deliberately forgot to record some expenses. So expenses are too low. Now, first thing here, looking at recorded expenses doesn't help either of these, because in the second case, liabilities are too low. We're looking for an unrecorded expense. So looking at recorded expenses doesn't help. And the reclassification out of expenses into assets, we won't find by looking at expenses. The other thing we've got to be careful about here, if we're looking for fraudulent financial reporting, saying, oh, let me look at expenses and see if they're approved by management, or let me look at a journal entry and see if it's approved by management. Well, we've made the assumption that management is fraudulently approving something. So looking at a journal entry and going, oh, management approved it, is absolutely no help. If we think it's a fraudulent journal entry, we have to do something other than looking at management approval. The other question I have is, are we done yet? So as we're designing our approach to a section, we will start with the simplest test, a simple analytical procedure. Compare it to last year. Are we done yet? Well, it's prepaid expenses, negligible risk and material misstatement. Yes, we are. It's another component. Try another analytical procedure. Are we done yet? Nope. Okay, internal control testing is pretty simple. Let's try one of those. Are we done yet? And keep doing that until you decide that, based on your assessed risk and material misstatement, you've done enough work for a low risk, a moderate risk, or a high risk, and so on. Procedural auditing, you need to abandon it. Let's always send out a bank confirmation. Not required. Let's always send out receivable confirmations. Not required. Now, there are some places you have to attend the inventory count, subsequent events, there's a list of procedures. Make up an audit program, do the required procedures. But procedural auditing was replaced by the risk model, which went into standards 1986. Now, it wasn't terribly clear, and since 1986, in 3 or 4 or 5 stages, it's been clarified and provided more detail, but it really hasn't changed since 1986. So if you're automatically doing the same procedures in every audit, that's wrong. Stop doing it. So to summarize, if risk of material misstatement is low, the amount of work we need to do is low. We must document the reason for risk of material misstatement. Other than if it's low, then the documentation of it's low is I can't think of one. Think about what journal entry we might make. We're not looking for fraud. We're looking for fraudulent financial reporting. Ask the question, are we done yet? And abandon procedural auditing. So, thanks for listening.